Because while Cuba spiraled into darkness and Venezuela's oil sector was pulled into yet another geopolitical chokehold, something very different happened north of the border. Quietly, strategically, almost unnoticed. Canada saw an opening. Not a short-term spike, not a political headline, a structural shift in the global oil market. One that reshaped supply chains, rewired refinery dependencies, and handed Canada a rare multi-year advantage. Not in the US, but across Asia. This wasn't about sympathy. It wasn't about ideology. It was about timing, infrastructure, and a competitor collapsing at exactly the wrong moment. And by the time markets caught on, the damage and the opportunity were already locked in. Because Trump didn't just cut off oil to Cuba. He accidentally changed who controls the world's heavy crude.
For decades, Venezuelan oil played a very specific role in the global energy system. It wasn't light, easy crude. It was thick, viscous, high in sulfur, the kind of oil that only certain refineries in the world are built to handle. That matters more than most people realize. Refineries designed for heavy crude can't simply switch to lighter oil overnight. Their entire infrastructure, pressure systems, heat cycles, chemical treatments, is tuned to that specific product. Change the supply, and the refinery either shuts down or spends millions adjusting. Before Trump's move, Venezuela was still producing roughly 900,000 barrels per day, far below its historical peak, but enough to anchor heavy crude markets, especially in Asia. China alone imported around 144 million barrels of Venezuelan oil in 2023. India relied on smaller volumes, but still needed it to keep specialized refineries running efficiently. Then came the cutoff. Trump's declaration eliminated Venezuelan oil shipments to Cuba entirely and redirected control of Venezuelan petroleum flows toward U.S. priorities. Whatever oil moved would be marketed under American oversight, with U.S. refineries first in line. That instantly removed Venezuela as a reliable supplier for Asia. Not gradually, not over years, overnight. And when one of the world's largest heavy crude suppliers vanishes from Asian markets, the question isn't whether there will be consequences, it's who fills the gap. Here's the part most coverage missed. Canadian heavy crude isn't similar to Venezuelan oil. It's almost interchangeable. Same thickness, similar sulfur content, same refinery requirements. For years, both competed for the same buyers. But Canada had a problem. Geography. Nearly all Canadian heavy crude flowed south into the United States. Not because Canada wanted dependency, but because it lacked alternatives. Without pipeline access to tidewater, Canadian producers were effectively locked into American refineries as their only viable customers. That dependence shaped everything: pricing, politics, trade leverage. So when Venezuela collapsed in the 2000s, U.S. refineries shifted toward Canadian oil. And when Venezuelan production partially recovered, those refineries didn't go back. The relationship had already stabilized. The supply worked. The same dynamic now faced Asia. Except this time, Canada had something it didn't before: an exit. The Trans Mountain Pipeline expansion was controversial from the start. Years of delays, legal battles, environmental opposition, indigenous resistance, cost overruns that turned it into a national debate. But one thing it did, quietly and decisively, was give Canada direct access to the Pacific. Suddenly, Canadian heavy crude could move west instead of south, from Alberta to British Columbia. From there, on to tankers headed straight for China, India, Japan, and South Korea. This wasn't hypothetical planning, it was operational reality. And it came online just as Venezuelan supply collapsed for Asian buyers. Without Trans Mountain, Canadian oil would still be trapped inland, begging for U.S. access. With it, Canada could bypass the United States entirely. Timing like that doesn't happen often. When Trump redirected Venezuelan oil toward American refineries, Asian buyers were left exposed. China lost its largest heavy crude supplier. India, already cautious about geopolitical volatility, suddenly faced refinery risks. Alternative suppliers existed, but none matched the combination of scale, stability, and compatibility that Canada offered.
Russia was unreliable under sanctions. Middle Eastern supplies were vulnerable to regional conflict. Venezuela itself was no longer trustworthy, even if oil technically existed. Canadian crude, by contrast, was boring. And in energy markets, boring wins. Stable production, predictable contracts, transparent regulation, no sudden expropriations, no military seizures, no leadership collapses. Canadian producers didn't need to pitch aggressively. Asian refiners were already calling. Energy buyers don't just look at price. They look at risk. Refinery shutdowns cost millions per day. Supply disruptions ripple through entire economies. Once a refinery adjusts its operations around a particular crude blend, switching suppliers becomes expensive and disruptive. That's why long-term contracts matter more than spot deals. Reports suggest Asian refiners began exploring multi-year agreements with Canadian suppliers almost immediately after Venezuelan flows were redirected. These weren't panic purchases, they were strategic shifts. Once those contracts are signed, they don't unwind easily. Even if Venezuela somehow recovers years from now, those buyers won't rush back. Switching again would mean retraining staff, recalibrating systems, renegotiating logistics. If Canadian supply works, it sticks. And history supports that pattern. Prime Minister Mark Carney didn't treat Trump's Venezuela move as a distant foreign policy issue. He treated it as a market signal and responded like someone who understands how energy power actually shifts. Within days, Carney began emphasizing Canada's ability to deliver stable, reliable, heavy crude to global buyers who suddenly had fewer options. This wasn't loud or confrontational. It was deliberate. Speaking from Europe shortly after the announcement, Carney highlighted Canada's competitive product and the urgency of diversifying export markets beyond the United States. On the surface, it sounded like standard economic language. But to Asian energy buyers, the message was clear. Canada was ready to step in, fast, and for the long term. This wasn't just federal messaging. Provincial leaders and industry groups echoed the same theme. Pipeline access to tidewater was no longer framed as a future goal. It was presented as an active advantage. Canadian producers were encouraged to think globally, not regionally. Carney's approach avoided drama, but it carried weight. By signaling stability, openness, and long-term reliability, Canada positioned itself as the safest heavy crude partner at the exact moment Asia needed one. And that calm, strategic response is what allowed Canada to move quietly while others scrambled. Even under the most optimistic scenarios, Venezuela is not coming back quickly. Its oil sector isn't just underperforming, it's structurally broken. Pipelines haven't been properly upgraded in decades. Refineries operate with outdated equipment. Skilled workers have left in large numbers, and rebuilding that workforce alone would take years. Reports claim it would require tens of billions in investment just to restore Venezuela's output to previous levels, and that's before factoring in political risk. Foreign energy companies remember what happened in the past. Assets were seized. Contracts were rewritten. Promises didn't hold. That history makes investors cautious, even now. And time is the one thing Venezuela doesn't have. While recovery drags on, Asian refiners can't wait. Their facilities are already operating. Their demand is immediate. Once they lock in Canadian heavy crude and adjust their systems around it, switching back becomes expensive and disruptive. That creates what analysts call sticky supply relationships. Even if Venezuelan oil eventually returns, it won't return to the same buyers. The market will have moved on. Canada will already be embedded in refinery operations, pricing models, and long-term contracts. That multi-year gap isn't just a pause, it's a permanent shift in who Asia depends on for heavy crude. Trump's move was meant to project control. By cutting off oil to Cuba and asserting authority over Venezuelan petroleum flows, the goal was to tighten Washington's grip on energy in the Western Hemisphere. On paper, it looked decisive. In practice, it triggered the opposite effect. And that's where the irony sets in. By redirecting Venezuelan oil toward U.S. priorities, the administration didn't just punish Cuba, it removed Venezuela as a dependable supplier for Asia. That single shift forced Asian refiners to confront an uncomfortable reality. Their heavy crude supply was now exposed to U.S. political decisions. And once that risk became obvious, buyers started looking elsewhere. They didn't need speeches or guarantees. They needed certainty. Canada offered exactly that. Not by challenging the United States directly, but by being ready when others weren't. Infrastructure already existed. Production was steady. Contracts could be honored without fear of sudden seizures, sanctions, or leadership chaos. While Washington focused on leverage, Canada focused on availability. This changes the balance of power in subtle but important ways. When trade disputes arise, leverage comes from options. If Canadian producers can sell to Asia at premium prices, tariff threats lose their bite. If American refineries know Canada has alternatives, negotiations look very different. Dependence quietly flips into choice. And this isn't a one-off accident. It fits a broader pattern. Every time pressure is applied too aggressively, markets adapt. Supply chains reroute. New partnerships form. Once those relationships settle in, they don't easily unwind. Trump's action was meant to demonstrate dominance. Instead, it accelerated diversification. Canada didn't announce a rebellion. It didn't frame this as a victory. It simply stepped into the space that opened up. By the time the consequences are fully visible, the real shift will already be locked in. Not through confrontation, but through quiet market reality. What makes this moment so significant isn't the drama of the decision. It's the silence that followed. There was no global emergency meeting, no public scramble, no loud declarations about a new energy order. And yet, behind the scenes, the global heavy crude market began to reset itself. Trump's move was framed as strength. Cutting off oil to Cuba and asserting control over Venezuelan petroleum was meant to send a message about American authority. But energy markets don't respond to messages. They respond to reliability, access, and time. And on all